and welcome to Indianomics. What has amazed economists and policymakers both in India and the US is the resilience of growth. US GDP in the first quarter, that is the Jan-March quarter 2023, was upped to 2% from an earlier estimate of 1.3%. I mean, that's some increase. Likewise, India's GDP growth in the same period, Jan-March, came in at 6.1% against market forecasts of 5.1%. Growth has remained resilient in most of Asia, excluding China, and this has spurred a reasonable rally in equity markets across the world, US, Europe, Asia. The strong growth and the accompanying still strong inflation has led to more than expected rate hikes from all leading central banks, including the US Federal Reserve, the ECB, the BOE, the Bank of Canada. But this is also taking interest rates, especially the US interest rates, to levels not seen since the late 90s. Can this have a delayed but a strong reaction on growth? Are we headed for a recession or a soft landing? Can there be financial accidents if US rates went closer to 5.5% or 6%? And what about India? Portfolio investors have been crowding in on the chorus that India is the fastest and best growth story in town. Is this a justified expectation? To answer these and other questions, I have with me Barry Eichengreen, Distinguished Professor of Economics at University of California at Berkeley. Professor Eichengreen, thank you very much indeed for joining me today. Global investors very much want to parse the US growth story. So that really is my first question. What do you expect the Fed to do? Is it one and done? Will it be two and done? Or do you think there can be even more in terms of rate hikes?
I think there can be more than one or even two additional rate hikes. The Fed's policy will be data dependent. The minutes that we received yesterday indicated that the majority of FOMC members see the pause as a one-time thing. Core inflation is still hovering around 5%, so I would expect to see them continue to tighten unless there is bad news on the growth front.
Okay. Well, in that case, if interest rates went to between, say, to 5.6% in the US, if that's the Fed funds rate, can we have accidents like we saw in the regional banks?
We can certainly have more accidents. So I think the regional bank cases, Silicon Valley Bank, et cetera, had some special features, but there are a number of banks that have balance sheet risk that will materialize as the Fed continues to raise rates. What the Fed tells us is that they have other instruments other than interest rates that they can do to ensure that financial stability risk remains contained. So I do not think that the danger of accidents in the financial system will deter them from continuing to fight inflation.
Okay, but there are people who even speak about commercial real estate likely to throw up bad loans or default. The larger question is that if interest rates go to a level which the system has not seen, a whole generation has not seen, can it have a delayed but cataclysmic impact on growth? I mean, what I mean is a hard landing.
Yeah, I do think there is a risk of events in financial markets spilling over to the real economy later this year. So you mentioned commercial real estate. Other real estate, residential real estate, is beginning to feel the effects of higher interest rates. And I do not think, building on your opener, that equity markets, that stock markets would remain immune to those effects indefinitely.
Okay. Well, while I keep asking experts this question, whether it can be a hard landing, whether things can be cataclysmic, sometimes we ask ourselves, are we too much children of the Lehman crisis? Are we just traumatized in our psyche that we see huge collapses around the corner? Can we still get away with a soft recession?
I think it is possible, certainly in the United States, to get away with a relatively mild short recession because household finances are relatively strong because consumer spending has remained surprisingly buoyant, because sectors like motor vehicles are doing very well. And I think the Fed now has room to reverse course if and when it becomes necessary. So as I said, I do expect the Fed to continue to tighten because inflation remains entrenched. But if circumstances change, the Fed will change its view and interest rates can come back down.
Yes, but the only problem is it works with a lag. If they were to change too late. In that context, how much should central bankers harp on their actual target? Should they be faithful to that 2% in the US? In India, it's 4%. Can you blink when it is at, 4.5% or 5% in India or 3% in the US and learn to live with it?
Well, I think that is a matter of timing. In other words, the Fed is fully committed to its inflation target of 2%. And the only question is, when will it get there? How quickly will it force inflation to converge to 2%? Will it wait until 2024? Will it be comfortable seeing inflation come down to 2% at the end of that year? I think one can ask similar questions about the European Central Bank and even the Reserve Bank. As long as they credibly signal that the target is intact and they remain fully committed to it, they have a little bit of a wiggle room in terms of timing.
Okay. What is your, how much chances would you give to even more than 2 rate hikes? The growth story is so strong in the United States, especially when you look at some of the lead indicators, including or especially labor data.
I would hang my hat on 2 more rate hikes. While the economy is strong, while consumer spending is strong, inflation is gradually coming down, and there is a lot of artificial statistical momentum in the inflation numbers because of rental rates on homes that are based on lag data. So I do expect inflation to continue to come down, but it can take 4, 6, 8 quarters before it reaches 2%.
As you speak, Professor Eichengreen, we are showing the US core PCE inflation numbers, and they've been pretty sticky at 4.6. I mean, the movement is all between 4.69 and 4.62. It's really climbed down so much, which is what many economists complain. That's why I was trying to prod you on whether even more than 2 is likely if core inflation remains so sticky. You don't think that's a possibility?
Well, I think the Fed focuses on core inflation. The Fed is aware that core inflation is a bit elevated by that statistical anomaly related to rental rates that I referred to before. I don't think it's alarmed that inflation is so inertial and that it will not come down. And I think the Fed is aware of that recession risk that you and I were talking about before. So it will continue to tighten given what the data are currently saying, but I don't think it will overreact in that direction either.
Okay. Let me ask a question which we have almost forgotten, which was quite common in the post-Greenspan era. Would central bankers be ignoring asset inflation? We have seen a significant amount of equity market rally, both in the US and in India and in other countries. At some point in time, should central bankers worry about that, even if the CPI is somewhat reined in, but asset inflation continues because of the global rally, because of the nature of liquidity? Should that be separately worried about by central bankers?
I'll give you 2 answers to that question. Answer number 1 is no, they shouldn't worry. Okay. They should keep their eye on their inflation target, and if they have a dual mandate like the Fed on healthy growth of output and employment, but they should worry about the financial stability risks that might arise if asset prices rise too high, the bubble bursts, and then the market crashes. Problem being that central bankers are no better than you or I at detecting the bubble and knowing when asset prices are out of line. So central bankers are aware that when the stock market is high, people feel more prosperous and they will spend more. That will have some implications for inflation, but that's a secondary consideration in their calculations.
Okay. All right. Now, let me come to emerging markets like India. Inflation has not been such a bother compared to our targets. We are very close to our 4% target. The last number was 4.25. The fear is that the coming numbers would be closer to 5, but that's still not a very big distance from 4%. Do you think that they will have the elbow room to actually go against the Fed and actually cut? Or should they really worry about interest rate differential becoming too small?
No, I think the Reserve Bank of India and other major emerging market central banks should focus on domestic economic developments, be they inflation or anything else, and not worry too much about the Fed. So it's clear that what the Fed does has global repercussions. But emerging market central banks, including India's, began to tighten before the Fed. Maybe they can begin to loosen before the Fed.
No, I didn't get you, sir. You think they can, choose another course? You think they can choose to cut, not just pause, in spite of the Fed remaining hawkish?
I think the answer is country-specific.
Okay.
It varies depending on what the inflation and economic situation in a given country is. In China, for example, at the moment, the economy is visibly weakening, and the People's Bank of China needs to support economic growth, and that means not tightening along with the Fed.
Yeah, that has led to a reasonable depreciation of the yuan. Now, in India, we are not used to this kind of a narrow differential between the Fed fund rates and the Indian repo rate. It's at the moment down to 150 basis points. But if the Fed were to hike and the RBI stand pat, it will narrow down to perhaps 100 basis or even less. Isn't that a worry? I mean, can't that trigger something for the currency, some capital outflows?
Well, I think India's finances are broadly stable, that people shouldn't be worried about banking problems at the moment. People shouldn't be worried about a currency crash. At the moment, I think the RBI is being vigilant, as central bankers would put it. The Indian growth story is intact, notwithstanding problems in China and U.S.-China political tensions, which are a worry for all of us.
Okay. I'm glad you used the phrase India growth story, because that is a chorus we hear. And I do want to hear your views on that. Have to take a mandatory commercial break. Back in a jiffy to discuss about the India growth story, the issue of China and their growth story, and what can that mean to the global economy. Back in a jiffy. Welcome back. I've been speaking with Professor Barry Eichengreen, the Distinguished Professor of Economics at University of California at Berkeley. Professor Eichengreen, thank you very much for your patience. Before we went to the break, you referred to the India growth story, saying that it is sound. There is a lot of bonhomie, a lot of cheer about the India story. Do you think the economy can grow sustainably at 7% or thereabouts?
I think 7% is ambitious. It's a target worth pursuing. I would guess something closer to 6% over the next decade or so. The infrastructure push is a good thing from the point of view of Indian growth, and eventually it will be a good thing from the point of attracting foreign direct investment. India will benefit from friendshoring. In other words, we've already seen Apple move some of its iPhone assembly from China to India, and with better infrastructure, I think we can see more such movement by other companies. The wild card is new technology. I wonder whether artificial intelligence, generative AI, is good or bad for the Indian economy. In other words, AI is going to be able to do a lot of the high-tech things that are currently being done in India, including coding and a variety of other high-tech services. So whether the Indian economy will be able to capitalize on those new technologies or not, as I said, I think is a wild card.
Okay. Yes, that remains one of the most debated issues in India. Whether it's going to make us better off or worse off in the sense of taking away some jobs. But that debate for another day. There is another issue about growth which is often spoken about, and that's what we call the K-shaped recovery. Clearly, it's premium products in every category that's doing well, and mass consumption appears to be not growing to the same extent. Maybe the skew is there in other countries, but in India itself, can that be an obstacle to growth, or can we grow in spite of being a two-speed economy?
No, I think India needs to even out the hills and valleys in its growth story. It needs to grow agriculture, manufacturing, and services. It needs to bring the lagging states up to speed. It needs to deal with the fiscal problems of the profligate states. So I think that, as your viewers will know, the growth story here has been uneven, and keeping it going at 6 or 7% will require bringing the laggards, whether we're talking about states or sectors, up to speed.
Okay, yeah, that would remain perhaps an issue of politically driven transfers of income. But to come to another issue, I have more questions on India, but how do you assess the China position, Professor Eichengreen? The Chinese growth story clearly looked wobbly in the second quarter after reasonable growth in the first quarter. Does it look like we're going to see a sustained period of slow growth in China, or do you see it coming back to perhaps an average 5% or more?
I think China is still enough of a planned economy, and the authorities have enough policy levers to prevent a very serious growth slowdown from being sustained. So I would expect the economy to come back. It's not going to grow again at 6%, but something on the order of 5% for several years going forward, I think is realistic, and the authorities will use monetary and fiscal policies and their control of the 4 big banks to ensure that happens. Okay.
Well, now let me come back to the India story. More from the currency angle. There has been a lot of dissatisfaction, especially after the United States de-recognized the Russian reserves. A bit of a fear if all reserves have to be kept in US dollars. There's been a flight to gold in some central banks. Do you see the dollar position getting threatened at all as an international medium of exchange or as a reserve currency?
Only at the margins. So the relative importance of the dollar as the dominant global currency had been declining very slightly over time already, in my view, for a couple of decades. And I think that evolution will continue, that as we move toward a more multipolar global economy, we'll also move toward a more multipolar global monetary system where the dollar is less dominant. But sanctions are not going to accelerate that process dramatically because there are not a lot of places to turn. The other attractive currencies besides the Chinese renminbi, their issuers are all on board with the sanctions against Russia. Gold is an awkward unit to hold as reserves and do transactions in. There is no alternative to continuing to hold and use dollars. So I don't expect that to change dramatically in response to recent events.
There's a great deal of interest in India about a little more international role for the rupee. In fact, just this week, an internal group of the Reserve Bank has presented a report on how to make the rupee a slightly more international currency, an evolutionary role. Do you think that role is possible? I mean, there has been a bit of a rupee-ruble trade. The buying of crude from Russia has been without using the dollar for obvious reasons. But is it possible that there can be a bigger role, international role for the rupee, especially if central bank digital currency were to develop?
As the relative importance of the dollar in the global monetary system has declined, what we've seen is a growing role for a variety of other currencies like the Canadian dollar and the Australian dollar, even the South Korean won. So in principle, there is no reason why the rupee couldn't be added to that list. It wouldn't become a dominant global currency, but it could be used more widely in international payments as markets in Indian government bonds and other assets become more liquid and payments become more fluid. But as we say, Rome was not built in a day. It will take years, maybe even decades, for that transition to be completed.
Oh, yes. I guess even the Reserve Bank of India group report is looking for an evolutionary role. But there is that desire to make the rupee a medium of exchange, at least for countries like Sri Lanka, for Middle Eastern countries with which India has a lot of trade. There is, of course, a problem that India runs a deficit with many of these countries, and hence the problem of their accepting the rupee. But to come back to where we began, Professor Eichengreen, when do you expect the Fed to start cutting? Do you think it happens, say, in a year?
If we see a recession at the end of this year or beginning of next year in the United States, the Fed will start cutting. If we avoid any kind of landing and the economy continues to grow, we're going to have to see how inertial core inflation remains. The Fed could pause again, and it could stay on hold for a while into next year.
Okay. All right. Well, that's what a large part of the equity markets are betting on. The risk rally is betting on an early shift, an early pivot, probably a couple of more hikes, as you pointed out, but a cut probably early next year and with some luck later this year itself. Professor Eichengreen, it's been a pleasure speaking with you. Thank you very much for joining us and giving us your take on the global economy and on the Indian economy as well.
Good to be with you.